Is your financial advisor outsourcing investment decisions? Perhaps one of the most important things that the financial advisor, financial planner, wealth manager, whatever title that they use, it's all kind of the same thing, isn't it? Perhaps one of the most important functions that that individual serves is to help make sure that your investments, right, are on the right track. For us, that kind of means that their performance is as good as it can be, right? I mean, isn't that the most important thing when it comes to your investments at the end of the day is performance, obviously on a risk-adjusted basis? Well, when that's entirely outsourced, things like rebalancing, things like investment allocation, how much investment advice are you actually really getting from that individual? So on this week's program, we're going to talk about what has become just an incredible trend in the industry, where just in the past year, there's been a 25% increase in sort of these outsourced model portfolio types of investment sleeves, if you will. A total of $8 trillion is now in that option, expected to grow to nearly 13 trillion. We're going to talk through some of the pros and cons of that approach, and or you may want to be, as we typically say on the program, asking some questions about your investments. Know what you own, as we regularly say on this program. And then we're also going to talk a little bit about those expanded tax breaks that appear to be on the horizon for 529 college savings accounts. Obviously potentially untapped, but they're in the bill and appear to have bipartisan support. That may be the only thing that's got bipartisan support these days. We're going to talk about what 529s are, just kind of recap that for you, how they work, and what these new features may allow you to do. Here's a little forward disclosure of it. The good news there is that they're going to expand the definition of qualified educational expenses, which will make 529 college savings plans potentially even more valuable. So we'll talk about that on this week's program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of podcast platforms throughout the fabulous internet. Make sure you check out our YouTube channel as well, and our website at Nelson Financial Planning, where you can obviously get redirected immediately to our channel on those favorite podcasts or YouTube platforms that you may like. And then when you're there, make sure you subscribe, because then that way you don't have to do that whole process all over again. My name is Joel Garris, going solo on this week's program. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries, which they normally will join me, but this week we are flying solo, so hopefully I'll be able to stay in my lane, if you will. That team stands ready, willing, and able to help you improve your life with a successful and cost-effective financial plan. So, busy week. Let's start to unpack it, as we like to do here in the opening segment of the program. It's got a host of things to chew on, from the Israel-Iran ongoing conflict. Can you really call that a conflict? It seems kind of one side in terms of how that's going. The impact on the price of oil, obviously, as a result of that. We had a Fed meeting this past week, and the market only had 4 days or 4 trading days to digest it. So let's start in that order. Clearly, the Israeli-Iran conflict, pretty significant. Lots going on there. You don't need me to tell you that. I suppose Israel might be doing us all a favor by taking out the potential nuclear capability of Iran, but I guess that conclusion is probably more for the military and intelligence experts to decide on that one. But For you and me, the immediate impact on all of this is shown when you drive past a gas station these days, right? Price of crude in the past month has jumped from about $60 a barrel up to about $75, I think, at last check. So, that is a pretty significant increase, almost 25%, if I'm doing the math right in my head, in terms of the price of oil at the pump, as is sort of the pattern. It seems like that's even been a quicker and bigger increase. If I'm thinking correctly, I think maybe at some gas stations you've seen about a 50-cent increase in a gallon of gas. So that's certainly got an impact for sure, especially, of course, with the upcoming 4th of July holiday weekend, where I know many people hop in their cars and drive and all of that good stuff. So against that backdrop, so layer in that uncertainty and whatever the impact or the length of time that the impact that will have on gas prices. So you got that sort of new uncertainty layered in on top of the tariff conversation, and lo and behold, the Federal Reserve met this past week and ultimately decided to once again hold interest rates steady. Pros and cons, of course, on anytime they hold rates steady. In some respects, they're saying that, hey, you know what? We're not too freaked out about what's going on in the economy, so we're going to keep the status quo. Of course, the reality is that the more you lower rates, the more, in theory, you would spur economic activity. So you can kind of understand sort of the political pressure that is happening to cut rates. But what was interesting about this meeting this past week, and this is something that we wanted to kind of talk in a little bit more detail on it, they did leave the door open to future cuts in the second half of the year, and that's sort of been their approach anyway. But the reality is that labor markets and inflation are staying in relative check, and those are kind of the two big data pieces economically that they look at. Interestingly, the new interest rate projections highlight a little bit of a divergence here as we kind of approach the halfway point of 2025. There's 19 Fed officials who participate in the meetings. 10 of them at this most recent meeting expect the central bank to cut rates at least twice this year, which is a narrower majority than in March. And in fact, 2 out of those 19 folks that participate in the meeting actually penciled in only one cut. 7 of those officials, so 7 out of 19, that's a pretty significant number, actually penciled in no interest rate changes at all this year, which is up from just 4 in March. You can see where sort of the mindset of the Fed is kind of shifting a little bit in terms of what actually is happening relative to the economic data. I suppose if you're reading the tea leaves on all of this, it would seem that if there are any rate cuts, don't necessarily expect a lot of them. At least that's the sort of the perspective for right this moment. That can always, of course, change. And then in the U.S., of course, it was just a 4-day trading week. Thursday, market holiday celebrating Juneteenth. That is the federal holiday here in the U.S. that commemorates the end of slavery. Juneteenth actually historically was first recognized as a state holiday in Texas in 1980, became a federal holiday here in the U.S. on June 17th of 2021. Also this past week, if you check out our Facebook page, you will see the posts that Jamie did on our social media. Our team participated in the Great Big Backpack Build this past Wednesday, where according to the numbers, we stuffed 845 backpacks for needy kids here in Orange County. The benefit obviously The event benefits Orange County Public Schools, and then in this neck of the woods, school starts relatively soon. I think it's like August 11th or something like that. So gearing up for that, and then of course during the course of the summer, and this starts next week at the office, our annual school drive that benefits a gift for teaching and tools for Seminole schools. So if you're interested in participating in that, just stop by with your new school supplies or old electronics for recycling at the office. With that, we're going to take a break and gear up more here on the program Dollars and Cents with Joel Garris of Nelson Financial Planning. On this segment, we're going to talk a little bit about a troubling trend in our view, and that really is this significant increase in financial advisors outsourcing investment decisions. Now, I don't know about you, but I would imagine, or at least this is what I think, being in the industry as a financial planner, that one of the most important things that your financial planner, your financial advisor, your wealth manager, whatever they call themselves, okay, you get the idea. It's the person that kind of helps with your finances, right? Probably one of the biggest things they do is to make sure that your investments are doing the best that they possibly can be, right? I mean, that kind of makes sense. And so the issue is when that's entirely outsourced, the rebalancing, the underlying allocation, how much investment advice really then are you actually getting? And the disturbing trend of this, and there's a lot of layers to this, so stay with us during the course of this segment as we kind of break this all down. The rise in these kind of model portfolios, these prepackaged portfolios, are basically these preset investment templates that are designed by money managers such as large wealth management firms or the like of like UBS, Morgan Stanley, as well as asset managers like BlackRock or Fidelity. And so here are the numbers. The assets in these model portfolios rose to a record $8 trillion as of April of this year. That's up from about $6.4 trillion just a year ago, a 25% increase in just a year. It's estimated that more than 8 in 10 fee-based advisors in the U.S. are now using these models with client assets. The issue is multi-layered, as we said. It also appears that it is very popular and its popularity is on the rise. Over the next 4 years, estimated growth in these model portfolios is expected to reach over $13 trillion. So this is a trend, if you will, or an issue that I think investors need to be aware of, particularly for those that are investing in the range of $100,000 to $1 million. Now, in the financial biz, if you will, that category of investors, that investable assets, $100,000 to $1 million, that is generally known as the mass affluent. That's the title, okay? Because you're not, if you got less than $1 million, between $100,000 and $1 million, you're not really considered high net worth because you need more money than that. Certainly not considered ultra high net worth. I don't really know where that break point is, but usually high net worth is above $1 million. Although some people I think say above $5 million. Ultra high net worth is above 10, or maybe it's about 20. You get the idea. But the mass affluent definition, generally considered investable assets between $100,000 and $1 million. And the reality is that certainly if you look at the ads, you see ads on TV, you see ads on the internet, wherever the case may be, that's a segment, if you will, that many advisors and institutions sort of ignore, right? I mean, if you got a minimum of $1 million, you're not really talking to these people in this group, which I guess gives you some insight into why this trend is happening. If you don't have $1 million, then the industry is basically saying, and has been saying this for some time now, we don't really want to, help you. I suppose we'll take your money, right, and stick it into, kind of this prepackaged product thing. I think the messaging, in our view, is kind of makes you scratch your head because how can you say that you're in this business to help people and improve their lives and all of those kinds of things if you only want them if they've got over $1 million, right? I mean, that just kind of, right? Hard to claim you're a fiduciary if all you want is people with money, I guess, right? But anyway, by the way, that's why at Nelson Financial Planning, we've never had account minimums, nor will we ever have. We firmly believe in helping people at whatever point they are on their financial journey. So, side note, a little commercial. Thanks for bearing with me on that. That shift, though, among that category and investors is really should catch your attention because there's a few issues with all of that. First and foremost, prepackaged, right? Easy solutions are designed for just that, right? I mean, if you have a prepackaged frozen entree, it's a meal. It's prepackaged, but probably doesn't really taste the same thing. Probably doesn't have the same nutritional value as actually like a meal that you cook. So when you think prepackaged, I always go to the kind of those frozen dinners. Super easy to use, super easy to work with. You don't have to pay really a whole lot of attention to it. You just stick it in the microwave and hit the button, wait for the beep. And but the proliferation of these portfolios among the investing public, particularly sort of that mass affluent category, what we refer to as regular investors, by the way. I'm not sure where the mass affluent definition came from, but easy and quick to just jam money into these prepackaged solutions, because these model portfolios typically made up of predetermined selection of funds that sort of automates all the investing, the trading, and the rebalancing, and all of that. So that's kind of the shortcoming. Number one. Number two is that there's a tendency to kind of focus on a limited number of investment managers. And unfortunately here, the reality is that it's all in an effort to more fully control your dollars at every level of how they can be invested. So beyond the advisor relationship or the planning relationship, it's, well, how do we actually get money from the actual investment of those dollars? So oftentimes the financial institution that the advisor or planner or whatever the title is, works for wants nothing more to control every aspect of those dollars through the creation of these model portfolios that heavily feature funds managed by the very same institution of which you are working with. Here's an example. This easy example. In late May, so last month, BlackRock tweaked its model portfolios and added in portions of a couple of its new ETFs into the mix of assets. In a matter of 3 days, the assets in those ETFs surged by 10-fold. Talk about driving dollars to your product. This should strike you as like there's so many problems with this, right? And at the end of the day, any investment that was managing $100 million, we'll say, and now is managing $1 billion, that's a huge difference in terms of economies of scale and how that money runs. And then that obviously creates some investment performance issues as well. Generally, these model portfolios have a tendency to steer a larger portion to the more conservative side, more bond side, more cash side, in order to kind of take the attitude of, hey, we're going to not do any harm kind of thing. And not to say that you shouldn't have some portion of your assets in bonds and cash and conservative stuff, but those funds, those model portfolios have a tendency to steer to that much sooner than you would expect. So what can you do about all of this? Well, first, be aware of the trend. That's what we're here for, to kind of clue you in on what's happening out there. If you're in a model portfolio, or if someone is suggesting that, then start to ask some questions. Things like, how much of the decision-making process is the individual financial advisor or planner actually involved in? How many of the individual funds in the model are being managed by the parent institution? Do the funds in the model portfolio actually have long-term track records, maybe at least 10 years or 20 years? Or are they brand new and the institution is looking to just kind of goose the numbers or the assets under management in those funds? If you can't get those questions answered quickly enough, or there's some vagueness to it, then I would suggest to dig even deeper. Bottom line, it all comes down to what we say regularly on this program: know what you own. That's one of the most important things that you can do as an investor. By the way, Nelson Financial Planning, we don't use that stuff. We're going to take a break. This is Joel Garris here on Dollars and Cents. We're going to shift to what I will consider as a little bit of a positive trend in this segment, and that is some of the changes that have happened, particularly to 529 college savings accounts, really are making those investment options a much stronger option for funding of future education. And so what we're talking about is these 529 college savings plan. So let's set the table a little bit, and then we're going to kind of go to Washington for just a minute, if you will, in the conversation and talk about some of these expansions that they're looking at doing for these plans that really do make them even more attractive than they are right now. So first and foremost, a 529 college savings plan is a way in which that you can save in a tax advantage way for future college expenses of a particular individual. When you open up an account, you name a particular beneficiary. That's the individual that those funds then get to be used for. And certainly in our view, we've talked about those many times before in prior programs, but probably the best option, mainly because contributions aren't limited based on how much income you earn in a particular year. Plus, you also have the ability to fund those with much larger contributions than some of the other options that are out there. And obviously, if you're funding it with more money, then it has the potential to grow to a much larger sum of money. Certainly can attest to their user friendliness and their ability to grow over time on a personal basis, because that's what I use to pay for a good portion of my 3 sons as they went off to college. The real benefit, of course, to these 529s, it comes from the tax-free growth. While the contributions aren't necessarily tax deductible, although in some states they are. So if you're listening to our program in a different state than Florida, make sure that you check that out. But the reality is that when you put the money in, even though it's not tax deductible from a federal perspective, the entire growth then becomes tax-free when you use the money in that account for, here's the key term, qualified educational expenses. So the last part, that key term, is sort of where Washington is focusing on expanding the available options that really could make these accounts much more attractive. Now, the reality is that when Washington starts to talk about doing things to help improve options, the reality is that when it comes to these 529 college savings accounts, there's about 17 million individual 529 accounts. So, I mean, that's a lot of them out there. All told, they hold about $500 billion of assets, so a pretty significant amount of money in them. Obviously, that's correlated to, I think, a lot of people being concerned about, how much college costs. So you're trying to do something ahead of time and fund money into these types of accounts. So, certainly pretty flexible. They don't have any real income or contribution limits except for kind of the normal gifting parameters. Even that gets expanded with these accounts where you can accelerate 5 years of gifting, which translates to a total available contribution of $95,000 that you can put into these accounts during any kind of 5-year period of time. So the gifting exclusion or exemption amount for this year is $19,000. So 5 times 19, that's where the $95,000 comes from. So imagine, obviously, if you do that, there's a lot of potential growth on that kind of money. So the good news here is that the folks in Washington are actually looking to expand the ability to utilize the funds in these accounts. Sort of a continuation of a trend that we've seen of late. Last year, for example, there was a new provision that came online that allowed the remaining balance in 529s to actually be used to make Roth contributions for the beneficiary. So that was very attractive. And this year, it looks like they're also going to expand how these accounts might be used as well. This one actually has bipartisan support in Washington, so that might be the only thing. The expansion that's on the table now is the expanding the ability to use the 529 in terms of what counts as a qualified educational expense, right? Because if it doesn't count as a qualified educational expense, here's the bad side, is that if you use money in a college savings account and you don't use it for a qualified educational expense, you got to pay taxes on the earnings, plus there is a 10% penalty. So the broader the definition gets, the more attractive these accounts can become, because it then covers more and more things. So a lot more flexibility that is being bandied about in Washington these days. On the table is the expansion of this definition of qualified educational expenses to apply to students at private, at public, at religious, and at home schools. So opening up sort of that definition. In addition, what is being contemplated is increasing that definition to include the cost of curriculum materials, books, and other physical or digital instructional materials. So that's a new one when it starts to open up coverage for books. Tuition for tutoring or classes outside the home, again, expanding out the option. Fees for dual enrollment in early college programs, and even testing fees for things like the SAT or ACT would now be covered, assuming that this passes in Washington. So pretty expansive lists, especially when it starts to pick up those books, those educational materials, tutoring, all of that. So really broadening out the definition. And beyond that, even for those not attending college, they would get the opportunity to use these accounts for things like credentials and licensing for professional education that would be required of various skilled trade types of occupations. Right now, unfortunately, that's limited to only credential programs like EMT or HVAC training, and only when offered through community colleges or other eligible institutions. So this would really kind of expand out where you might be able to use those funds. So we certainly remain very hopeful that these changes will make it into the final bill in Washington. I think the original time frame was that they were going to try and get all of that wrapped up by July 4th. I'm questioning whether they'll hit that time frame because there's a lot of moving parts on all of this. The good news is that we are hopeful that these provisions will see the light of day in whatever that final bill is, because both sides of the aisle really are interested in helping parents mitigate the ever-increasing cost of college. But beyond that, also starting to recognize more and more that, hey, not everybody goes to college. And frankly, maybe that doesn't make sense for a lot of people. A lot of these skilled trades jobs pay incredibly well, and there is a shortage of people going into that. So why not expand out these accounts to really be thought of more as increasing or promoting education just in general. And so certainly these types of expansions will go a long ways to sort of reassure parents and grandparents who, they want to save, but they're not really sure, whether the kid's ultimately going to go to school or what the cost might be. These proposed changes certainly provide those folks that want to save for education a lot more new and sort of useful flexibility. So as we like to say, stay tuned for how those potential developments play out. Certainly not law yet, but we wanted to inform you of what appears to be that trend in Washington. Certainly last year's change that allowed for remaining balances in 529s to be used for Roths is a really great option that was not there prior to last year. So having support to expand out the opportunities to use these monies for a variety of college and educational expenses really is a good thing. So hopefully all of that makes it in the final bill. As we say, we will keep you posted on how all of that plays out as the weeks and months go by. With that, we're going to take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planner. So here's an interesting stat that caught my eye this past week. My desk always gets flooded with a bunch of information each and every week. And from time to time, we find something interesting and we decided to share it with you, our listening audience here at Dollars and Cents. And so this one that caught my eye this past week helps to sort of put the market's recent movement into perspective. So if you look at the period from like April 8th to June 8th, so that 2-month period of time, looking at the S&P 500, that broad gauge of 500 companies in America, ultimately during that 2-month window, the S&P 500 actually gained more than 20%. Now, if you're keeping track of your calendar, April 8th was sort of the day where there was an announcement in Washington that a lot of the tariff stuff was going to basically kind of get suspended, or at least for 90 days. If you look at that performance of a 20% increase in a 2-month period of time, that is just the 6th time that much growth over that short of a time period happened in the past 70 years. So why does that matter? Why are we kind of bringing attention to that? Well, interestingly, if you look at the prior 5 times that a similar rise of that amount happened within that short of a time period, and just for historical reference, the 5 times were 1975, 1982, 1998, 2009, and 2020, by the way. The S&P actually was higher over the next 1-month period, the next 3-month period, the next 6-month period, the next 12-month period, every single time, with an average gain over the next year of 31%. So an interesting stat that I think might make you think a little differently about where things are, looking at the markets, looking at your investments. There's always a limitation or a concern that if you're thinking the market's topped out, it can't go up anymore because of a recent run-up. History tells us that you might very well be in for a surprise. I think all of this and all of these stats that we kind of share every now and then on the program really do underscore one of the main themes that you've always heard from us for as long as we've been doing this program, which is now close to 40 years, is that, not me, of course, I'm way too young for that. It was my father-in-law who started it. The reality is that it underscores the notion that it's really hard to time the market. It's really hard to predict the future. It's far better to be consistent with your investment strategy than to try and figure out when to hop in and when to hop out. So, some food for thought, if you will. So as we enter into the final segment of the program here on Dollars and Cents, always a good idea to kind of recap our topics du jour, if you will. The big increase in advisors using model portfolios, we talked about earlier in the program, a jump to up almost $8 trillion, 25% increase over how much money was in those accounts from just a year ago. And we asked the question, and it's an important question for you to be asking, is your advisor, your planner, whatever they call themselves, sticking your money into one of them? Are they doing that because you don't technically meet their kind of their account minimum size of $1 million or something like that? Do you know? I mean, it's those kinds of things that you need to be asking about your money. As we say all the time on the program, know what you own. And it's crucially important to ask these questions because the reality is that we see 3 limitations and concerns when it comes to these prepackaged model portfolio things. And the first is the obvious, which is, prepackaged stuff. I mean, it's not, might be easy and they're just, designed to be that way, but not necessarily in the best interests of the client, not necessarily going to get the best result when you use anything that's easy and prepackaged, right? I mean, TV dinners are easy. Just take them out of the freezer, stick them in the microwave, hit whatever it is, 5 minutes, 6 minutes, I forget, wait for the ding. Voila, you have something that is food, but it doesn't make it necessarily a good meal. Similarly with model portfolios, well, yeah, you've got an investment portfolio and it's, doing what it's supposed to do, I guess, but It's not quite the same thing as having a little bit more individualized insight into exactly what's going on with your investment. So that's number one. Number two, and this is where the stats really kind of jump out at you, the limitations in terms of the investment managers that are used in them. And often these managers happen to be affiliates of the firm that you're dealing with. And then the way in which they sort of adjust sort of the preset mix of the model to ultimately route more money to funds they control. You just can't really be too surprised if, for example, a new ETF gets introduced into the model portfolio, and all of a sudden it's 10 times larger than it was within like 3 days. That's a significant redirection of assets that just speaks to just conflict of interest upon conflict of interest. And oftentimes in these model portfolios, you will see just that. Limited investment managers, often affiliated with whoever it is that you're dealing with, that ultimately are adding in funds that they also create, manage, might be subsidiaries. And all of that, of course, leads to our third sort of concern on this, which is that investment performance certainly winds up not being as good as it could be. That's generally the issue with models anyway. They have a tendency to skew a little bit more conservative than what you might otherwise want as an investor. All of that done to kind of reduce down liability, things like that for the industry as a whole. So bottom line, as we always say on the program, watch out. Make sure you know what you own. If you have one of those model portfolios, then it's probably time to dig a little bit deeper. Proliferation in the industry is pretty staggering. As we mentioned, we don't use that stuff. But if you want us to review what you have, obviously that is something that we do on a no cost, no obligation basis. So make sure you go to our website at Nelson Financial Planning and look to schedule one of our free consultations, because we'll sit down and have a conversation with you. We'll run the analysis on it. We'll tell you what it looks like. Whatever it is, we'll let you know. Good, bad, indifferent, ugly, pretty, all of that. We'll give that to you in a written report. On the flip side, as we said earlier, a potential trend that is positive is the expansion of the options when it comes to using 529 plans, 529 college savings plans, to really maximize out the benefits of it and make sure you're not getting into where you have to pay taxes or a penalty for using those funds. It really centers on that definition of qualified educational expense. If you use the money in a 529 college savings plan for qualified educational expense, then you are golden. If you don't, then it's taxes plus a 10% penalty. The reality is that what they're talking about in Washington is expanding that definition, sort of continuing the trend that we've seen last year. For example, the option to use 529 money to fund and make Roth contributions came online. Certainly this new coverage that expands what qualified educational expenses are to things like books and tutoring and all of those kinds of things certainly is a good thing that could potentially come out of Washington. Hopefully that change remains in the final bill. Stay tuned on that. Certainly on future programs we'll be talking about that once that bill actually gets finalized. Looking ahead to the week in front, my goodness, we've got our mid-year conference call, which actually we're doing it as a video chat. We do it every year around this time of year. Good way to kind of see where we're at halfway through the year, what's been happening, what we might expect for the rest of the year. So if you're a client at Nelson Financial Planning, make sure you join in on that. You've got the invitation and the links to connect in and to dial in as well. So we're looking forward to that. Also, as we mentioned, not this upcoming week, but the following week is when we start our annual school supply drive that runs at the office during business hours between July 1 and September 1. To participate, all you need to do is drop off new school supplies. We're also collecting old electronics for recycling, so that is all good. The school supply drive benefits a gift for teaching and tools for Seminole schools. With that, we're going to wrap it on up. and get on out of here. This has been Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents.